For those serious about becoming successful, consistently profitable options traders, now is the time to build skills in technical analysis, market analysis, and applied volatility to get those results. We have multiple memberships, starting with our Go membership that teaches rules-based trading and our Pro membership that teaches more subjective trading. For more information, go to lockinyoursuccess.com/memberships.
Hello everyone, my name is John Locke and I'd like to welcome you to The Winning Trade, but first the required disclaimer material. This presentation is given for educational purposes only. We're not broker-dealers or financial advisors and we're not making any specific trade recommendations. Also, please be aware your risk in trading options is substantial. Please make sure you're aware of all your risks prior to placing any trades. Also note that the trades and results in this presentation are hypothetical computer simulated trades. They're believed to be as accurately represented as possible. Keep in mind, live results can vary from simulated results for many different reasons. If this is your first experience with us, my name is John Locke. I'm a trading performance, wealth, and success coach with Locke in Your Success LLC, where myself and my team of mentors are here to help you win in the markets and in life as well. And today, we're going to do another demonstration on high probability options trading. This is where we utilize option strategies to make money with the help of the passage of time, rather than or in addition to, depending on price movement in order to be profitable. This means we can often make money whether the market goes up, down, or sideways. And the trading strategy that I would love to share with you today is called the Bull. We've been trading the Bull since 2007, and we've backtested it since 2002. It's an extremely simple, easy to manage strategy traded on the Russell 2000. The strategy takes advantage of bullish and neutral market conditions. What we do is on the Wednesday closest to 65 days to expiration for our option cycle, we enter a 10-point wing bullish vertical on the Russell that gets a credit of more than $2.50 per contract. We check the strategy once a day if the market is down. If the position drawdown is greater than the credit received, or $2.50 per contract, we will exit the position, or we will exit the position when the next monthly trading cycle or monthly companion cycle in the weeklies is 65 days to expiration. And that's it. As you can see, it's extremely simple. So the bull trade is going to require a minimum of $750 if you're doing it on the Russell, a minimum of $75 to trade if you're doing it on the IWM. So you can trade these in very small size. We're going to do an example of a 10 lot. So we're going to have a $7,500 planned capital. On that planned capital, we're going to have an exit loss trigger of $2,500. And as far as a profit target, there is no profit target. We only exit due to time, or if it were drawn down more than we should be. As far as the entry, there is no technicals that we check. There are no adjustments. And like I said, the exit are under those two conditions. So extremely simple rule set. This strategy since 2002, that's almost 22 years, has produced an extremely and surprisingly good result over that period of time. And of course, we're expecting this to continue as we go forward. So let's take a look at the strategy. So today I would like to show you two examples of the bull strategy. The first example is going to be January 2024 expiration cycle, and the second example is going to be February 2024 expiration cycle. What we do here is we come in and we take a look at our put options when we're 65 days to expiration on our option cycle. And in this case here, we're doing the January 19th expiration cycle, and 65 days to expiration is going to be November 15th, 2023. We're going to come in here and we're going to sell usually about a 30 delta put. Sometimes that put is a little bit more or a little bit less delta. Our objective here is to get at least $2.50 per contract credit after execution. So if we come in here and we take a look at our 30 delta in this case, and we buy 10 points underneath that, in other words, we're doing a put credit spread of 1750 and 1740, and we'll get an expiration graph that looks something like this. This is our expiration line here, which shows us the value of our position at expiration should we let it go there, which we're not going to. And then we have what's more important is our T+0 line, which is right here. From here, the trading strategy is extremely simple. basically, if the market gets down substantially underneath 1804, we're going to want to watch this in order to exit it on our exit loss trigger. Other than that, we do nothing until our February cycle is 65 days to expiration, which is going to come in approximately 30 days. Could be a little bit more or less depending on the expiration cycle width. So here, our exit for this trade is going to be if the asset price or the drawdown gets to about gets more than $2,500. If we want to estimate here, that should come if the Russell gets down to about 1710. All right, so any other market movement, we're really not that concerned about. And we just go day to day. Again, there are no adjustments until our next cycle, 65 days to expiration. I'm just going to take a look at the price chart just so you know what's going on, keeping in mind that we are not using the price chart whatsoever in order to do this trade. It doesn't mean you can't do that. One of the things I like to do with my trading strategies is I like to know what the baseline performance is on the strategy with absolutely no subjectivity. That's true whether it's a bull trade, an M3, an M3.4U, or any of the other strategies that we do. I want to know what my base rate is. What's my base probability of this working out? And what kind of profits can we expect? What kind of drawdowns can we expect? And then from there, I add subjectivity to it. And that way I know if I'm adding subjectivity, whether I'm doing a good job or not. Because if I'm not even beating the base rate, then of course I'm not doing a very good job from a subjective standpoint. My point being is we've tracked this since 2002 or for 22 years with literally no subjectivity whatsoever, and the results are fantastic. And if you'd like, if you're a more subjective trader, if you understand technical analysis, adding a little bit of subjectivity to this properly can really, really bring your results even much higher. So that's what's pretty exciting about this. So here, I'm just going to go ahead a week or so. Actually, I'm going to show you the price chart. So let's do that. This is what the price chart looks like so far. You can see the market's been up substantially, and this is where we're at. So let's move along. Well, actually, let's look at the price chart first. So when you take a look at this, our stop out point's down in here somewhere. If the market reverses, if we don't get under that point, then we don't really have an issue. So let's just go to 1 week into the trade. And realistically, this is what's happened. The market's decided to consolidate a little bit here. We did not hit our stop out point. If we go to the next week here into the trade, we're now up about $180. We take a look at the price chart. We're pretty much at the same price we were on entry. If we go another week into the trade, market starts to take off a little bit, and we're up 1880. Go another week into the trade. We have hit our exit date. So basically, we sat in this trade. It is now December 13th, Wednesday, December 13th. Our new options expiration cycle is 65 days to expiration. And therefore, we're going to, we made that period of time without stopping out and drawing down enough to stop out. And we end up being up about 23.55. So what we're going to do, because we are at our entry time of our new trades, we do not overlap trades in this case. Not to say you can't do that. If you'd like to do that as a trader, that's perfectly fine. But this is the strategy guidelines that we've used. We're going to exit this trade and we're going to enter February. So this trade gets closed down at about a $2,350 profit. And we go over into our February position, which is 65 days to expiration. We come in and we look for the 10-point wide spread that's going to give us $2.50 per contract. In this case, it's a little under 30 delta for our short. We enter that trade, and this is what our expiration graph and T+0 line looks like. It looks like we're going to have a stop out if the market goes down to somewhere around about 1840. Okay, that doesn't happen. We don't have any concerns. As far as our price chart, this is what our price chart looks like. Okay, so let's move and we'll do the same thing here. We'll go week by week. So if we go to week 1, the market continued to go higher, and this is where we stand. If we go to week 2, we're up $1,930. And again, the market's continuing to climb under these conditions. And if we go to the following week, we're getting our pullback now, right? So we're down. We had quite a bit of a pullback. So now we're only up 630. This is what the price chart looks like here. One of the wonderful things about a bull trade that a lot of people don't think about is the traders who try to trade flat delta will draw down money a lot of times in an up move like this, or they won't make any money and they'll be adjusting up, adjusting up, adjusting up. And then when you get these big pullbacks like this, a lot of times that trade will lose. The great thing about a bull trade is when that scenario plays out, we're still fine. I mean, yeah, we lost some profits, right? But we're still perfectly fine. There's not really an issue. If we go to the following week, I'm going to ignore trades here. This is what we look like. So right now, we're 37 days to expiration. We're up $730. If we take a look at our March expiration cycle, it is 65 days to expiration. That being the case, it is time to exit. We're going to take our profit of $730 and we're going to move into March. And the March entry position is going to just look exactly the same as we have here. And by the way, we have already exited the March position at a profit, and we are in the April position, which is also at a profit at this point. So the strategy does very, very well over time. Does it ever lose? Yes, of course it does. So does any other strategy. But the probability is extremely good. And again, we've had fantastic results since we've been trading this. So as far as the results, we had for the bull trade for those two cycles, we had a 31.3% gain on planned capital in January, and we had a 9.5% gain on planned capital in February, making for a whopping 40.8% in two expiration cycles. Fantastic, fantastic results for this episode's winning trade, the bull strategy. If you like what you see, I invite you to come on over to lockeinyoursuccess.com. That's LOCKE inyoursuccess.com, so where you can follow along with the bull strategy and many other great strategies as they unfold during our weekly options trading for income webinars that we have with our Go members. Also, where you can learn about upcoming winning trade presentations, explore past winning trades, and receive access to free bonus material. Also, while you're there, please be sure to check out our free trading performance podcast, where you can learn to skyrocket your trading regardless of the type of trading you do. If you have any questions, comments, or anything else you'd like to see in the next winning trade, please make sure you post those in the comments. I answer comments and requests personally. Thank you for joining me, and I look forward to seeing you on the next winning trade.